Welcome, everybody. Welcome to part 3 of Gust and Vouch's everything you need to know about insurance while you're growing your company. Part 2 of Gust in Vegas. That's not a fake background. We're actually at the ACA conference. The ACA is the Angel Capital Association. It's a bunch of angel investors and angel groups. They are one of the earliest stage that invest in companies. And when you're getting an investment, one of the last things you probably think an angel is going to ask you about is your insurance. But it is actually very common, especially professional angels. We're coming off mania of funds raised, safes getting signed quickly and funds being transferred and people not really doing a lot of diligence early on. But things are changing, and a huge portion of the capital that flows into startups doesn't come from that kind of mania investing. It actually comes from organized angel groups all over the world. And those angels are professionals, and they're going to ask for protections that most startups aren't aware of, especially if they're researching and they're just in the Valley mindset or YC. But they will really care because they want to be sure that their investment is protected, that if the company goes through trials and tribulations, it can survive them rather than just placing, heck, I'm in Vegas, putting everything on black and just like hoping for it and then having it be a huge catastrophe. So I am happy to be joined by the Vouch team again. Ali and Chris are here to guide us through what to look out for and what kind of coverages you'll probably be expected to have, and you should probably get even if somebody doesn't tell you other than us. This might be a little shorter event because it's very focused, but we're going to have plenty of time for Q&A. And because we'll have extra time, ask all your questions, even if they're a little adjacent to insurance. We'll get through some healthy Q&A at the end. We're going to record it. We will share it out. I will be flying back, so it'll probably take until mid next week before we have everything together. But we'll probably send something out to kind of top off the whole 3-part series we did with Vouch, all the resources and things that we mentioned, the recordings and anything else. So without further ado, Ali and Chris, please take it away.
Amazing. Thank you so much, Ryan. And welcome back. I don't know if many of the folks on today joined the last couple of sessions or today's the first one that you're joining us for, but either way, welcome. Not biased at all, but this is probably the most exciting and relevant milestone. I think raising capital is something that is top of mind for most folks these days, particularly just given a lot of the shifts in the environment and in the fundraising landscape. So really excited to spend time with you all today, kind of talking about this specific milestone. So before we get into it, my name is Ali Schneider. I lead the partnerships team here at, I was going to say Gust, but here at Vouch. We love working with Gust as a partner. We love working with Gust companies across the board. And our goal at the end of the day is really to help you all feel really confident in your risk management programs and best practices as you're growing and scaling your businesses. So I'll hand it over to Chris for intros, and then we'll get into it.
Awesome. Yeah. Thanks so much, Ali and Ryan. My name's Chris. I'm one of the licensed insurance advisors here at Vouch. Just completed my first year with the company, part of a dedicated team of advisors here to answer any questions you have about raising capital, coverages that are appropriate at different milestones of your startup journey. So really excited to kind of just dive into this one with everyone today.
All right, let's do it. And welcome back, Elias. I'm so glad that you're here for the third session too. All right. Wonderful. Okay, so we're going to do, for those who didn't join the last couple sessions, we're going to do a quick kind of a recap for you. The one thing I'll say is please ask questions. We want these sessions to be as helpful as humanly possible. I see there's already a question in Q&A that we're going to get to. It's a great question. Keep them coming. That's what makes these sessions honestly most relevant and fun for us and helpful for you. So just ask as we go along, and whatever we don't get to throughout, we'll spend time on at the end as well. So cool. So just a quick, again, bear with us for folks that have joined the past couple sessions. We're going to do just a quick recap of why we're here in the first place today. But at the end of the day, starting a venture-backed business is inherently risky, and we know that businesses, for various reasons, don't ultimately make it. And a lot of this comes down to different risk exposures. And so, I think what we're going to focus on here today, if you think about the fundraising milestone in particular, right? A lot of companies fail due to lack of funding, right? And the ability to actually raise capital or deliver the returns that investors see, right? Those are fairly big risk exposures for your business. And so that's why we're going to focus on this particular milestone today, and what are the things that you can do to kind of prepare for the risk exposures that come along with, the fundraising process, and once you've actually raised capital itself. And as founders, one of your most critical jobs is to do this and de-risk your business. And so we've shared this, matrix and kind of simple yet pretty effective framework for how you can think about risk at a high level for your business. because you have options at the end of the day, right? And it's your job to make sure that you're employing the right strategy depending on the risk exposure. So, one of the things that we always tell our founders that we work with at Vouch, and, we're a high growth startup ourselves. So we use this framework every day, thinking about the risks that we face while building a high growth company, is always trying to evaluate two things. So, what is the chance of something happening at the end of the day, right? What is the frequency? And also, how severe is the potential loss if that thing does happen, right? So a rogue LaCroix spilling on a laptop, that might be, maybe it's low frequency and low severity. So you say, hey, I'm going to accept the chances of that happening. And if someone does that, I'm going to pay for a new laptop, and that's what it's going to be, right? But what if something is, low frequency, but really high severity, maybe a data breach, right? Getting hacked. We talked about cyber and customer contracts last week, right? That's a different type of scenario there. That might be an area where you say, hey, insurance is really important. And right, we talked about some of those risks last week. You also want to think about mitigation strategies, right? So what are the things that you can do to decrease the chances of a risk happening in the first place? It's going to be a really important strategy for things that are maybe could potentially happen frequently, but maybe aren't as severe of losses. And then you always have the chance to say, hey, I'm going to try to avoid that risk happening in the first place. But when you think about some of the risk exposures associated with, raising capital, right? Your avoid tactic there is saying, I'm not going to raise capital. So that might very well prohibit growth for your business. So you really have to kind of think about the matrix and use this on a really regular basis. So, really thinking on a strategic level, on a very regular level, right? What are the things that are keeping you up at night? Identifying the most important risk exposures. How do you want to prioritize those? So how likely are they to happen, and how severe will they be if they happen? What's your plan of action? What are you going to do if each of those things happen? And then monitoring that on a pretty regular basis. So before we get into the meat, we're going to do our quick, fun legal disclaimer. Insurance is one of those really fun things where the answer is often it depends. And the reason why is because it truly does depend, depending on the question, right? Pricing, coverages, recommendations. So much of what goes into designing the right insurance program for an individual company really revolves around so many aspects that are specific to your business. What stage you're at, how much capital you've raised, how much revenue do you have, customers, what technology you're using, et cetera. So we're going to do our best to chat high level today, but we're always happy to have, one-on-one conversations with folks to really help you understand the risk exposures and coverages that make sense that are specific to your business. So just a fun, quick little caveat there. All right. So the milestone we're going to talk about today is fundraising. So whether you are planning to raise capital, currently raising capital, have already raised capital, always raising capital, if you're a founder, I guess the process never really ends necessarily. Whether you're taking on venture funding, whether it's capital or venture debt, right? There are risks associated with actually taking those funds on as a business. Even if you're doing, venture debt, right? There's a whole different set of exposures there too. And so what we're going to do today is talk about the risk exposures, mitigation tactics, claim scenarios, which are particularly interesting for this category. I would say a lot of the risk exposures that come alongside with, bringing on investors and raising capital tend to fall into that like lower frequency, but very high severity category. So they're not things that happen every day, but when they do happen, they can be pretty catastrophic. And so what we'll do is highlight kind of two key coverages here that are going to come up. And those are directors and officers coverage and key person, which you might have heard a little bit about. Sometimes it's referred to as key man. We try to use key person where we can. Sometimes it's referred to as like the if you get hit by a bus coverage, which is a little bit morbid, but really important in terms of just general planning for the business.
Well, I think that one, I noticed that key person thing, and I appreciate that because in this space for so long, I've heard key man all the time. But it's super interesting because when a startup is early, the staff is absolutely essential to, you don't really think about it. I used to work at Boeing in defense intelligence, and we used to have what was called the hand grenade law, which was like a particular set of leadership could not be in the proximity that a hand grenade would wipe them all out. So you literally couldn't be on the same flight as another executive of a certain thing, or in the same bus. You would actually stagger it. But most people don't think about that for startups, but literally if you're the CEO, you're probably the only person that if you go away, the startup kind of goes away.
Yeah, and totally. And it's morbid to think about, right? But investors need to know that you have a plan in place, right? Should something happen. And so what's really important to keep in mind about these coverages before I hand it over to Chris to kind of get into some of the nitty-gritty is by the time you get to a Series A, your investors are more than likely going to require you to have both these coverages in place. Definitely D&O, they're probably highly going to recommend key person as well. And so one of the reasons why this education is really important, because it'll actually help prepare you for those fundraising conversations. You know, if you're talking to a potential investor and they ask, well, you know, how do you think about risk management, right? You know, for your board and executives, you know, what are your plans for getting D&O coverage? You'll have a lot more credibility in that conversation if you say, hey, you know, we're planning to get coverage as soon as the round closed. We actually already have a partner lined up. We have a good sense of pricing and what the right limits are. You'll have a lot less credibility if you say, what's D&O, right? So I kudos to everyone for kind of showing up today. I think that going through kind of the education piece will hopefully be very helpful to you within those conversations as well. In terms of just showing, you know, potential investors that you take the business very seriously, you take their interests as investors very seriously as well. So with that, I'll hand it over to you, Chris. We'll get into the fun stuff.
Awesome. Thanks so much, Allie. And I guess I'll just pause real quick to answer those two brief Q&A questions that came up in the chat about kind of being proactive, taking that proactive mentality when it comes to insurance. It works out well that we're on this slide, actually. So you do have the ability, at least with Vouch, to go in, complete our kind of Mad Lib application, and then typically receive a quote within the same day or within typically 2 business days there. And that can help you price out the D&O so you kind of know exactly what you're getting into if you are going to be raising a round pretty soon here. On that note, it's good to know that we refresh our quotes every 30 days, just speaking for Vouch here, not sure how other carriers do it. And then your application is valid for 90 days. So it does help you to kind of just, yeah, Eli, thanks so much for shouting that out. He and I have done this and it is very quick and painless. So it's worth it if you're trying to get a general sense of what pricing may look like. We'll kind of dive into the weeds on pricing exactly a little bit later on here as well. But going off of this side, so we're looking at the risk exposures with accelerating growth. So taking that reactive versus proactive mentality when it comes to it. So compliance is a big one. So operating in regulated industries. So regulated and litigious categories, as a company grows, it may be subject to a broader range of laws and regulations, leading to increased compliance risks. There's some directors and officers obligations people have to consider, maybe financial solvency. So rapid growth can pose financial management challenges, could result in inaccurate financial reporting, failure to properly manage finances, or even some misrepresentations down the road here. So it is also a good negotiating tactic and good negotiating requirement as well. So accelerating growth can attract more investors, as Allie already touched on there. So with increased investment comes increased scrutiny. They'll likely want to see that you've taken the necessary steps to secure certain insurance coverages. So kind of just wanted to lay these out, some more tactical things people should kind of be keeping in the back of their head while either approaching a new raise or kind of just getting started down that path. So feel free, we can go ahead and click to the next one here, get into it a little bit further. So risk mitigation tactics on this side here. So strong corporate governance being a good one in that. So implement strong corporate governance, clearly define those roles and responsibilities, maintain accurate records, establish robust corporate governance practices and procedures from the very beginning is just going to help you set up your startup for more success. Obtaining the legal and professional advice, the appropriate legal and professional advice is super helpful as well. Not only because they've probably been around the block and done this a few times, but it also helps you to adhere to some complex and legal regulatory issues that can arise. Also having those people in your corner to kind of regularly review and update your policies is super beneficial as well there. And then, of course, always positive to foster a culture of ethics and integrity. Really going to help you out in a lot more instances than just directors and officers particularly. And then manage investor relations is another big one as well. So being open and transparent, clearly communicating risks and uncertainties associated with your business upfront to potential investors is going to help you in a long run and may save you some headache with a misrepresentation kind of lawsuit. And then conducting due diligence and hiring is another really important one here. Can even come down to maybe bringing on some other executives, C-suite executives, founders, board members, et cetera. Being able to thoroughly vet and verify those requirements, experience, and track record of key hires is really going to ensure suitability for the role and then set you up for better success as well there.
And one thing I'll just add on the due diligence piece. I mean, we talk a lot about, when we're fundraising, right? How investors are doing due diligence on us as startups, but you have as much right to do due diligence on your investors, and you should, in terms of doing reference checks, talk to founders and the best VC firms that, really support their portfolio companies, they will encourage you to do that. And they will ideally give you the names of companies who have done really well in their portfolio and companies who have maybe not done well in their portfolio. And that's who you're actually going to learn the most from, is like, how do your investors support you in times of need? Because we talk to a lot of folks that say, you know what, I don't think I need directors and officers coverage. I have a really good relationship with, my investors and my board. And you could really respect people as individuals and as humans and have good relationships, but you don't always know how people are going to react or what people are going to do when things get really tricky or when things go wrong. And that's where, doing as much due diligence as you can on these people that you're bringing into this marriage, if you will, with you and your co-founders, it does help mitigate some of that risk. But at the end of the day, you can't control how people are going to react when things go sideways. And so it's just something that's really important to keep in mind.
I think that's an excellent point. And I want to kind of highlight that even in a good case, it can get tough, because money changes people's behaviors, and you can have lots of conversations with investors early on when everything is uncertain and we all agree it's uncertain and we like each other and we like the market or whatnot. But even in an upside or a downside scenario, money makes people very, very different. So it's a lot of people are planning for like, well, if it's a disaster and the company's going out of business, like the company goes out of business, it's out of my control. But sometimes a very positive event can trigger behaviors in people. And if you haven't known this person for however long, a toxic investor can really ruin a company in the early days. The best thing that you can do is find out, tough situations that they've been in or positive situations that they've been in with other portfolio companies. That's a fantastic point, Allie.
And that's a great point too, and focusing on how people react in the positive as well.
Awesome. So diving into the coverages, one we've mentioned already, that directors and officers coverage here. So really designed to protect your company and the personal assets of your founders, officers, board members, if they're sued over decisions they make on the company's behalf. So typically, directors and officers insurance covers the cost of legal defense, settlements, judgments, related claims to wrongful acts. That could include things like alleged errors, omissions, breach of duty by the directors and officers as well there. So coverage is designed to extend to both individuals and the company, which is really nice. We can kind of get into the sides of directors and officers coverage there. It's really there for providing financial protection from claims made against the directors and officers personally, as well as those claims made against the company as a whole. It's mainly important for attracting and retaining talented directors and officers is one of those key things there. It provides them with a level of protection, giving them confidence to make difficult decisions without the fear of like personal financial ruin, which is a huge asset to have. And then there's also increasing scrutiny on corporate governance and the rise of lawsuits against directors and officers. So D&O insurance really acts as a safety net, helping to mitigate the financial risks associated with such claims. And then it can also help protect the company's assets just by covering those defense costs and potential indemnification payments. So reducing the impact that a potential claim has on your organization's financial resources, really protecting those funds that we've mentioned before that your company's taking in now shows that you're taking it seriously. So when's an appropriate time to get it in place? So securing D&O insurance early does demonstrate a commitment to good governance and can enhance the startup's credibility in the eyes of investors, stakeholders, and potential partners. We do typically recommend it closer to that Series A funding round as well, as we've mentioned. And then if you're appointing new board members, especially important if you're in a highly litigious or highly regulated industry as well, just running up against more scrutiny, directors, officers, board members making harder decisions that are being scrutinized under a microscope. So important to have it in all of those instances.
Yeah. And I would just add on to, definitely that inflection point where you're forming that board, that initial board, super important, because it protects that board. It also protects you as the founders of the company. By the time you get to that Series A milestone, D&O will be required in your term sheet by whoever is leading you around. Is sometimes it'll be different limits. Sometimes they won't have a requirement around the amount of insurance. They just want to see that you have D&O insurance. So just something to keep in mind, and to be on top of and ahead of. What we have seen is many of the VCs and partners that we actually work with here at Vouch, will actually do like diligence to check and make sure that you have it. So, not all of them, but I will say a lot of them will come to you, a month or two after the term sheet and say like, hey, want to confirm that you got this coverage in place. Many of them will not ask for the COIs necessarily, but it's a really bad look if you say you have it, even if they're not like double checking the homework, and something does happen and it turns out you didn't actually get coverage in place. So just something to keep in mind there.
I think Elias has a great relevant question to this, because this comes up a lot. The entire thing we talk about is establishing a Delaware C Corp. It limits your liability. The corporate veil is established, so you're not personally liable for this. Why is that not enough? Why would you need more insurance than the C Corp that you're running that is a separate entity?
Yeah, it's a great question. I guess, Ryan, what's your experience kind of with that when you were going through these earlier phases? What did you kind of run into? Curious what that looks like.
Yeah, so we in Gus Launch, which is our company as a service platform that starts, a Delaware C Corp in Delaware, we make, very clearly sure that there are 3 articles on the COI, the Certificate of Incorporation, that say that the directors and officers of the company are not liable for, whatever incidents the company has. And the way we view kind of corporate law and protection is there isn't one thing that you can get that basically protects everything in every single case. You're really building up what we call layers of protection over the value that you create. And the more value that you create, and I know value is getting ridiculous in our industry, but value is money, assets, customers, products, whatever. The more that you're creating, the more you want to protect it. And like I've said a million times, the United States is not smart contracts aren't in there yet. So anybody can sue anybody for any reason. So if a bad thing happens, or somebody thinks a bad thing happens, or somebody is just a bad actor, they can put a lawsuit against your company. They can put a lawsuit against you personally. But the amount of evidence that they have to actually possibly win that lawsuit, or even to make it worth the money of getting lawyers and going to court and doing all the things, is based on precedent and contract law. So while Delaware C Corp is very much protected, the owners, not burgers, the directors and the officers, if you establish the corporate veil, which means you have a board of directors, you have officers, and you have shareholders, the stuff the company does in the early days is generally protected from the individual. If the company goes out of business and goes bankrupt, they're not going to come after your mortgage or your house or your car or anything like that. However, as you create value and more stakeholders are involved, investors, shareholders, employees, there's many cases where suits could be made for different things. And that's when you want to start to build up the layers of insurance. And I'm not an expert on D&O insurance, but I know there is a certain precipice where, just your COI and the various things like that might not be enough. And you guys probably have some scenarios or something that you can explain more on that, I hope.
Yeah, absolutely. No, thank you, Ryan. I was just curious. I wanted to get your perspective as a founder to kind of see what that looks like and everything. And I mean, it kind of goes down back to like our fund insurance answer of it depends. I mean, we could sit here all day kind of and go through all these crazy what if scenarios, but at the end of the day, yeah, it depends. And there is the potentiality that as you gain more traction and as Ryan alluded to, some more money and things there, success within your business, there's the potential that you personally are wrapped into those instances as well. So I'm glad we kind of shared on that as well. Early startup, like Ryan said, probably not relevant. It is a more costly coverage. And then if you're the only officer of everything and haven't had that traction or money, probably not going to come after your mortgage. So it depends at the end of the day there.
Yeah. And I think exactly to your point, Ryan, what it comes down to is like the layers of protection. So it's actually interesting to look at it in terms of how VCs look at insurance too. So for the VCs, they want their portfolio companies to, let's say you have, a VC firm and their partner takes a few different board seats, right? The first level of protection for the VC is to actually make sure that those portfolio companies have directors and officers insurance, because that protects that board member should that board member be named personally in a lawsuit against that startup. But the VCs will also have what's called general partnership liability insurance. So that's insurance for the firm. So the VCs also purchase their own insurance coverage as well. So should your D&O limit be exhausted, that's where the VC's insurance actually will come in on top of that and cover more of the legal costs, et cetera. So there are different layers. But exactly, it's, there are going to be certain cases where if you or your founder is named personally in a lawsuit as it relates to the business, that's really where that kind of D&O coverage is going to kick in to protect you as an officer, of the business.
I'm sorry. Did you guys lose me for a moment? I had to switch over to my cell phone. The internet went out in the hotel.
Oh, no.
We did, but you're back. You're good.
Okay. And the continuity is restored. Thank you.
You're great.
Fantastic.
Did I skip a slide? Oh, I did. There we go.
No worries. Awesome. So here we're kind of laying out some potential claims that may arise or that we've kind of been familiar with here as it relates to directors and officers insurance. So that first one, alleged technology taken from competitor is a big one in the industry, in the tech industry specifically. So let's say a VR startup launches a new product and the competitor files a lawsuit alleging the technology used was actually developed by the startup CPO while he was working for another competitor. So the resolution of an instance like this is that the D&O policy provides coverage for the cost of attorney fees to defend against that lawsuit. So you're not having to tap into your startup's funds there. You're not fully accepting that risk. And this directors and officers, it's intended to kind of pick up those legal fees there as you work through that lawsuit. So example number 2, SEC seeking documents and information. So let's say an officer of a startup providing an HR platform received a subpoena from the SEC seeking information and documents related to the startup's finances and customer lists. In an instance like this, the directors and officers policy is designed to provide coverage for the cost of the startup's attorney fees, again there, incurred to responding to that subpoena. And then finally here, the COO, maybe there's a misappropriation of some trade secrets. So a Series C project management software startup hires their first COO from a larger competitor. So a few months later, lawsuits filed against the startup and the newly appointed COO alleging misappropriation of trade secrets. In an instance like this, the D&O policy covers the cost of attorney fees incurred to defend the lawsuit, and the matter is settled after the startup is successful on an early motion to dismiss. So these are just some more broad examples, specifically more so on the tech side of things there, where we're seeing directors and officers really come in handy here to kind of pick up those legal fees, settlements, judgments, or fines that a company may incur if any of these were to pop up.
And I think one thing that's kind of important to note, like the majority of these incidents, right, are not always malicious, right? Like sometimes you don't realize you're taking, as a board member, maybe you sit on boards of 2 companies, to Chris's point, and accidentally kind of take information from one company to another, and then you're named, right? It's not always malicious, but sometimes it does happen somewhat unintentionally, just because of the nature of these relationships in the industries. Certainly there are some kind of malicious instances and bad actors. I think Theranos comes to mind when you think about, a founder like Elizabeth Holmes and like intentionally deceiving her board of investors in the lawsuits that she was named in. I don't want to know who was underwriting their D&O policy at Theranos specifically. But again, you think about these types of claims, and again, these are not things that happen every day. This isn't the rogue laptop that's spilling. This isn't going to be as common as like an employee lawsuit, necessarily EPL, which we talked about a few weeks ago, but these are big things. They don't happen a lot, but when they do happen, they can be really detrimental in terms of particularly the legal costs that go into actually kind of fighting and working through these lawsuits.
Absolutely. No, thanks so much. And just pausing real quick to answer the questions in the chat from Emily. So does D&O coverage also cover advisors? So it kind of goes down to, it depends. And this is why it's important to be familiar with your insurance agent and the carrier and kind of your policy lingo as well there. So Vouch's directors and officers policy has intentionally broadened the definition of an insured person to pick up someone like an advisor of the board, instances like that as well. So kind of does depend on the company. I know that we have an intentionally broad definition of insured person on our D&O because we realize that things are fluid and people are kind of constantly coming in and out of startups. So I just kind of check with your insurance provider, see what they're doing if you're not with Vouch there. And then related to the specific industries, medical devices is a good one. So if you're involved in healthcare, it's certainly something where we're seeing people secure the D&O coverage a little bit earlier on. I'd say anything having to do with finance, fintech is also another big one there too. But again, doesn't hurt to be proactive with looking for this. It does give you kind of some leverage going to that negotiation table as you're raising as well. So it's open to really any industry to kind of secure it in advance before it becomes a requirement. And we can kind of look at the pricing right now. So quick caveat, do want to clarify because we ran into some confusion about this. The 1 million, 2 million, don't think of that as the cost of the directors and officers insurance. At these earlier stages, it's a lot less than $1 million a year for directors and officers insurance, which is really good. Think of those non-regulated and regulated numbers kind of in those fields as the typical coverage amount that we recommend based on your capital raised. So kind of diving into that a little bit further here, regulated and non-regulated industry sectors, the amount of capital raised are the biggest factors that are going to impact the cost of directors and officers insurance. So the company's financial health and a strong balance sheet can also have an impact on it. So it's important to be aware of that. Some other kind of key features that can impact the cost of directors and officers is company size, whether or not there's previous claims or any pending claims that you're aware of at the time of applying, and then the policy limits that you select as well there. So if you're selecting a $5 million limit, likely going to be a higher premium than a $1 million limit. And then Allie, wanted to kind of just kick it off to you there, what we're seeing with like VC partner requirements, et cetera.
Yeah, it's a really good question. So honestly, I would say we don't always see required like a specific amount of insurance from VCs. More often than not, what they say is like, we just want to make sure you have D&O coverage. Sometimes we will see where we will see a limit maybe is if they have a board member who's sitting on your board and you're at a certain stage. So they might say, by the time you're at your Series B, let's say when you look at kind of it by capital raised here, you've raised over 20 million, they will often check in and say like, hey, do you have the right amount of D&O? It's important to always at each fundraise to revisit the amount of D&O insurance that you have to make sure that you're sufficiently kind of covered. Again, a lot of the VCs will not necessarily come and say like, hey, send me your COI. I don't believe you that that you got this in place. We've actually done a lot of user research around this here at Vouch. But they do trust that the way that a lot of our VC partners have said is like, we trust our founders to be, grown-ups and to do the things and follow through on the things that they say that they're going to do. And so again, being really proactive, even being able to say, reach out to them, like while you're in the fundraising process, pre-fundraise and say, hey, just so you know, we're prepared to do this. We have a good sense of what pricing is going to look like. We're going to purchase as soon as we close the round. Even following up a month after the round close and say, hey, just confirming we have coverage in place. We're good to go. XYZ board member is covered now. We'll go a long way just in terms of like building the trust and credibility with that new partner.
Yeah, absolutely. And then quick question related to kind of the cost, is this 5 to 10K per month at Series A? I'd say not typically. It does depend. I'll throw that fun disclaimer in there as well. It always is kind of going to depend, but I haven't seen 10K a month typically for a Series A funding round. It is, again, kind of dependent upon the capital that you're raising. So, I mean, if you're raising a huge amount of capital, it is likely going to be a pricier challenge. So it kind of depends on that side of things there.
But that is annual in terms of that bullet, in terms of benchmark, what we've seen.
Correct. So think of that as annual, not monthly. Thanks for that call out, Allie. Guys, so going over to the kind of the key trends that we're seeing impacting directors and officers. So we'll start with some macroeconomic factors leading to shareholder litigation. So there has been a notable rise in shareholder activism. So regulatory investigations, class action lawsuits against directors and officers. So this trend has led to increased claims, and then typically those increased claims also leads to a higher cost of directors and officers insurance. It is typically one of the pricier coverages that we offer here at Vouch, but for good reason there. And merger objections from shareholders is a big one there. There's an impact on public D&O and private D&O rates because of that. Reemergence of SPACs, for instance, kind of alleging inadequate sales prices too. They're all contributing to some higher prices surrounding directors and officers insurance. And then legal action against distressed companies alleging misrepresentation or breach of fiduciary duty is a big one there. So securities class action lawsuits continue to be a significant concern for directors and officers. And then these lawsuits typically allege misrepresentations or omissions in financial disclosures, and that results in investor losses. So D&O insurance policies kind of need to account for these heightened risks of such claims. And that's something that we're pricing into our policies that the industry is kind of just taking in general. So these are some of the key trends that we're currently seeing impacting directors and officers coverage specifically here.
Yeah, and one thing I'll just add, particularly on kind of like regulatory guidelines, one of the things, interesting stats that I think is important to highlight is roughly 40% of all D&O lawsuits actually come from non-compliance of regulatory guidelines. Right. So if you're in a highly regulated industry, we see a lot in fintech, we see a lot in healthcare, we see a lot in ed tech, actually. If there are certain like regulatory guidelines you're supposed to be adhering to and you're not, and you're named personally in a lawsuit for doing that as an officer of the company who's, not, following certain guidelines you're supposed to be, huge area of exposure there. And we've seen a lot of those claims, particularly. I mean, we don't have to look too far, right? If we look at kind of the fall and what happened with a lot of crypto businesses, FTX happens to come to mind there.
Awesome, guys. So why your coverage needs will change over time. So we're kind of going to hit on 3 different growth stages here. So starting firstly with the early stage. So startups in their earlier stages typically do have limited resources and a smaller executive team. So at that point, D&O coverage needs may focus on protecting just those founders, maybe some key executives from personal liability as the company kind of just starts to establish its operations. So there's more of an emphasis maybe on coverage from claims related to company formation, that corporate governance that we mentioned earlier, and then initial funding rounds. So startups at this stage often kind of prioritize the affordability and may opt for the lower policy limits that still offer some of those essential protections you're getting just by having directors and officers coverage in place. So then as your company grows, we're kind of getting into that growth stage of things. They typically secure additional funding and then expand their operations. So their D&O coverage at that point needs to evolve. So comes with an increasing number of directors, officers, employees. Coverage may extend to protect a larger group of individuals at this point, rather than just the founder and co-founder that it previously covered at the early stage. And then the scope of coverage may expand to include risks associated with like hiring, managing employees, and then that regulatory compliance that Ali mentioned is so crucial as the company becomes subject to more legal and governance obligations. And then finally, enhanced policy limits may be necessary to kind of align with the company's growing assets and potential exposure. So as we saw in the previous chart on the pricing side of their things, once you've acquired more capital, we typically recommend higher coverage limits. So as you're in that growth phase of things, typically higher coverage limits come into play on the D&O side as well. And then say, hey, you've had fantastic growth. Everything's going really well for your company. Maybe we're looking at like a pre-IPO or maybe exit preparation at this point. So startups preparing for IPO or potential acquisition may experience heightened scrutiny, certainly from investors, and then those regulatory bodies again. So the D&O coverage needs may include specialized like IPO related endorsements, expanded coverage for security claims, and then increased policy limits again to address the unique risks and liabilities associated with the IPO or exit process. And then attention may be placed on protecting the directors and officers from claims related to financial disclosures at this point, maybe prospectus misrepresentations or post-IPA governance matters as well there. So once you're kind of past that stage, maybe your company's at this point public, D&O insurance requirements undergo significant changes. So really, again, focusing more so on regulatory compliance obligations, expanding to really protect against like shareholder class action lawsuits at that point, maybe some derivative actions and securities claims. And then those policy limits we see at those stages substantially higher than when the company just is starting out. So you can kind of just wanted to give you a brief high level overview of kind of what it looks like. And your directors and officers coverage is always fluid and changing as your company experiences these different growth stages as well. Fantastic. So we'll get into key person here. So what's this cover? Really, key person insurance is a type of life insurance policy. Think of it that way. It's kind of provides financial protection to a business in the event of a death or disability of a crucial individual within the organization. So it goes back to that kind of like hand grenade thing. If you don't want everyone standing in the same place at once, if a hand grenade were to go out, it's really just designed to kind of mitigate the financial impact and potential disruptions that could arise from the loss of a key employee or founder. So it's specifically important because certain individuals within a company do play critical roles that are essential to its success and profitability, especially at those earlier stages. You may be the chief everything officer at that point. And if something were to happen, as Ryan and Ali previously mentioned, company could just fail at that point. So these individuals could be founders, maybe some key executives, maybe some key salesperson, even among others. And this really helps safeguard the business by providing funds to cover various aspects, such as like recruitment and training of a replacement if you lose that person, maybe some debt obligations, loss of revenue, or potential shareholder concerns also if you're at that stage. So really just designed to kind of provide you that financial stability during a difficult transition period if you were to lose the chief everything officer, for example. So when is it appropriate to kind of look at getting this in place? It's if you've identified that the loss of a specific individual within the company would have a really significant impact on your operations, financial stability, or future prospects. So if there's an individual within the company or individuals within the company that the company could not go forward without, it's time to kind of start thinking about maybe getting a key person policy in place for those individuals. So startups in particular, it's really important to assess the importance of key individuals early on and then evaluate the potential consequences of their absence on the business's ability to kind of function and grow. So it does get a little bit morbid. Nobody likes to think about it, but it is important to kind of point it out and realize, hey, if something does happen to the chief everything officer, things could go wrong for the company and just kind of trickle down from there. So that's where this key person insurance specifically kind of comes into play.
And one thing I'll note, full transparency here. So key person is actually a personal lines coverage compared to property and casualty coverage, which are the majority of the coverages that we've been talking about through these sessions. So full disclosure, Vouch, we can't sell you key person insurance. We don't have that personal lines licensing to do so. We don't have our own coverage. But we do have partners that we work with that are wonderful partners and sell key person, and we've kind of vetted their policies and have good faith in them. I'll ask, there's a question in the chat. Chris, I'm not sure if you know the answer to this, given that this isn't totally an area where we spend as much time here at Vouch, but how can a founder's personal belongings be protected against any claims from the startup side, like a home, car, or investments? Do you have a sense of that one?
It's a good question. I'm trying to kind of think. So, I mean, the directors and officers, the side A portion of the coverage really is designed to kind of pick up assets of individual directors and officers. So when the startup can't indemnify the individual to cover costs related to a claim, I'm not sure if key person, anything like that would kind of come into play though, honestly, Ali, when it comes to home, car, etc., on sides of things like that. So what's your 2 cents on that, on the question? It's a great question.
Yeah, I think this is one I would probably want to follow up with some of our partners that do key person. It's a great question, just because we don't look at those policies. We don't always have a good set. We don't look at them as regularly. So we don't have as great a sense of what they'll kind of pick up for some of these specific personal asset scenarios, but we're happy to take that follow up and also happy to connect you guys with any of those partners if that's of interest as well.
Yeah, absolutely.
Cool. And then just quickly, while we wrap up, I know we've talked a little bit about Vouch as we've gone through, but, our goal at the end of the day, we do business insurance specifically for high growth technology companies like yourself. So our goal is to be a resource for all of you. We offer many of the coverages, except key person, actually, that we've talked through over the last few weeks. So we're happy to be a resource on that side. We do have preferred pricing for guest customers, which is always really fun and always helpful, particularly at the early stage. Every dollar counts. So even if you're interested in going through and getting a quote, getting a sense of what pricing looks like, chatting with one of our advisors, getting their take on, the right program for your business. And we've got a ton of resources too, including our risk assessment tool is a really cool one that actually helps you go through and identify like what are some of the biggest risks for your business based on where you are and how to kind of put together that actionable plan that we talked about in terms of, accept, avoid, mitigate, and transfer. And so we are here to very much be a resource for all of you as you're kind of navigating the space. As founders, you have a lot to think about on a daily basis, and insurance is not one of those things that should be taking up more of your mind share, right? If we can make that process a little bit less burdensome and help you sleep a little bit easier at night, that is very much our goal. So definitely keep us posted on how we can help. And to Ryan's point, we're going to be sending out slides, recordings, follow-ups, etc., from the Grow series next week as well. So very much looking forward to continuing to keep in touch with all of you.
Excellent. Yeah, for anybody who joined late, we're recording this. We will share a recording next week, as well as I'm assuming you guys will give us the slides. We'll probably put all three together as well as a single follow-on for this, and maybe do kind of a thanks for being part of the whole series. If anybody has any last questions, or if you guys have anything else, I feel like that was near the end.
No, just thanks for joining. And Ryan, thanks to you and the Gust team for having us. We had a lot of fun doing this over the last few weeks.
Yep, and I'm sure we'll do more because we're having a great time with it. We're getting such a great response. So be on the lookout for emails from me and Allie. Chris, have a lovely weekend. And thanks again.
Safe travels, Ryan. Thanks,
Take care,
everybody.
Ryan.
Bye.